The double top is a bearish reversal pattern that appears after an uptrend. It forms two prominent peaks at roughly the same level, separated by a moderate trough. The pattern visually resembles the letter M on a chart. The neckline, drawn at the low point between the two peaks, serves as a critical support level. When the price falls below this neckline after the second peak, it confirms the pattern and signals that upward momentum is weakening. Entry is typically made after the neckline break, with additional confirmation if the price retests and fails to reclaim it. The double bottom is a bullish reversal pattern that follows a downtrend. It consists of two distinct troughs at nearly equal depths, separated by a moderate high. On a chart, this pattern resembles the letter W. A neckline drawn at the high between the troughs acts as a resistance level. When price breaks above this neckline after the second bottom, it suggests the trend may be reversing to the upside. A strong confirmation is a breakout with volume or a successful retest of the neckline as new support. The head and shoulders is a bearish reversal pattern that signals a shift from an uptrend to a downtrend. It features three peaks. The middle one is the highest, flanked by two lower and roughly equal peaks. A neckline drawn across the lows between the shoulders acts as the key support level. When price breaks below this neckline, the pattern is confirmed. Traders often wait for a retest of the neckline to enter short positions more conservatively. The inverse head and shoulders is the bullish counterpart, appearing at the bottom of a downtrend. It features three troughs. The middle one is the lowest, and the two outer troughs are higher. A resistance neckline connects the highs between the troughs. When price breaks above the neckline with strong momentum, the pattern confirms a potential trend reversal. The structure often indicates a buildup of buying pressure and is more reliable when accompanied by rising volume at the breakout. The rising wedge is a bearish pattern characterized by two upward-sloping, converging trend lines. Price moves within the wedge by making higher highs and higher lows, but the momentum gradually weakens. This pattern can form in both uptrends and downtrends, but it most often signals a reversal when seen after an uptrend. Confirmation occurs when the price breaks below the lower trend line with increased selling volume. Traders may enter short positions after the breakdown or wait for a retest of the lower boundary. The falling wedge is a bullish pattern formed by downward-sloping, converging trend lines. Price makes lower highs and lower lows within the wedge, but the movement tightens over time. This pattern can develop during both uptrends and downtrends, but it is typically seen as a reversal signal at the end of a downtrend. Confirmation comes when the price breaks above the upper trend line. A break with strong volume or a retest that holds support adds further credibility to the signal. The triple top is a bearish reversal pattern found at the end of an uptrend. It features three peaks that form near the same resistance level, separated by two moderate pullbacks. On a chart, this creates a flattened ceiling where price struggles to break higher. The neckline, drawn along the lows between the peaks, acts as the critical support zone. When price breaks below this neckline after the third peak, it suggests the buying strength is exhausted. A successful retest of the neckline from below often signals a high probability short setup. The triple bottom is a bullish reversal pattern that develops after a sustained downtrend. It consists of three troughs that bottom out at similar price levels, separated by two moderate highs. This pattern resembles a flattened floor on a chart, signaling the market's refusal to go lower. A neckline is drawn at the highs between the troughs. When price breaks above this neckline after the third bottom, it confirms growing buying strength. Volume spikes and a retest of the neckline as new support are key factors for confirmation. Cross resistance occurs when a previous resistance level becomes support, or vice versa, after a breakout or breakdown. This flip can be used to confirm the strength of a breakout. For a bullish setup, traders wait for price to retest the old resistance as support and bounce off it. In bearish cases, they look for rejection at the former support turned resistance. Entries follow confirmation of the new roll. The cup and handle is a bullish continuation pattern that looks like a teacup on the chart. The cup is a rounded bottom that forms gradually over time, followed by a small downward or sideways drift called the handle. This consolidation forms under a key resistance level. When the price eventually breaks above the resistance of the handle, it signals that the previous uptrend is ready to continue. A good entry point is either at the breakout or on a pullback that confirms the resistance has turned into support. The inverse cup and handle is a bearish reversal pattern that resembles an upside-down teacup. It begins with a rounded top followed by a slight upward drift just under key support. This pattern suggests a shift from bullish to bearish sentiment. A breakdown below the handle's support level confirms the pattern and often leads to sharp downward momentum. Traders look for a decisive break with increased volume and may enter short on the initial breakdown or after a failed retest of support. The bull flag is a continuation pattern that forms during an uptrend. It begins with a steep rise in price, followed by a short-term consolidation that slopes slightly downward or sideways, forming the flag. This pattern reflects a pause in buying before another move upward. The pattern confirms when price breaks above the upper boundary of the flag. A volume increase on the breakout adds strength to the signal, and some traders wait for a retest of the flag's resistance as new support before entering. The bear flag is the opposite of the bull flag and forms during a downtrend. After a steep decline, price consolidates within a slightly upward sloping or horizontal range, creating the flag. This pattern signals temporary relief before continued selling. When price breaks below the lower boundary of the flag, the downtrend often resumes. A high-volume breakdown confirms the pattern. Some traders choose to enter on the breakout, while others wait for a brief pullback that fails to regain the broken support. The broadening top is a bearish reversal pattern found at the end of an uptrend. It features diverging trend lines with price swinging in wider ranges, making higher highs and lower lows, and the chart shape resembles a megaphone. This pattern signals increasing market volatility and buyer exhaustion. Confirmation comes when the price breaks below the lower trend line with conviction. Traders may look to enter short after this breakdown, especially if accompanied by a failure to reclaim support or a spike in volume. The broadening bottom is a bullish reversal pattern that appears at the end of a downtrend. It is defined by two diverging trend lines, with the price making lower lows and higher highs. Visually, it forms a wide V shape, suggesting growing uncertainty and a struggle between buyers and sellers. The pattern is confirmed when price breaks above the upper trend line, indicating the start of a potential new uptrend. Entry is usually made after the breakout, and confirmation is stronger when the price retests the breakout level and holds it as support. The ascending triangle is a bullish continuation pattern formed by a flat upper trend line and rising lower trend line. It suggests increasing buying pressure as price approaches resistance. A breakout above the top line confirms the pattern. Volume typically increases on the breakout. Entry is made after the breakout or on a retest of the resistance turn support. The descending triangle is a bearish continuation pattern that features a flat lower support line and a declining upper resistance line. Sellers are gradually pushing the price down towards support. A clean break below the bottom line confirms the bearish continuation. Increased volume on the breakdown adds strength. Entry follows the confirmed move below support. The symmetrical triangle pattern shows consolidation, with converging trend lines where the price makes lower highs and higher lows. It doesn't suggest direction on its own, but usually breaks out with momentum. Traders wait for confirmation in the form of a breakout and increased volume. Entries follow the breakout direction. Trend channels are formed by two parallel trend lines that contain price movement during a trend. In an upward channel, price bounces between rising support and resistance, while in a downward channel, price declines between falling levels. Horizontal channels indicate sideways consolidation. Entries are taken near support or resistance, depending on direction. Breakouts from the channel can also offer trading signals.